There he is. Jose, so sorry you couldn't join us in person, but good to see you.
Yeah, my apologies for not being able to be in person there with all of you. Sorry to miss it in person this time.
Yeah, well, everyone, thank you for taking the time to join us for this session. Unless you've been living under the proverbial rock these past few weeks, you should have caught the news out of PayPal just a few weeks ago about supporting merchant crypto transactions. That's probably top of mind for most folks right now as they think about the firm. But before we get into all that, Jose, maybe just give us an overview of PayPal's role in the burgeoning crypto economy.
Sure, Frank. Happy to do that. So PayPal has been involved in crypto for the best part of the last 5 years or so. And the reason that we do is because pretty much like Stellar, because we are in payment. So for us, it's less of an ideology. We don't have laser eyes or anything like that. We started to tinker with those protocols 5 years ago from the PayPal side. I've been involved in blockchains for the best part of the last 10 years, always in a financial services setting. And the reason that we got excited by it was when we started to see, hey, you can move value in these protocols 26 times cheaper than an ACH transaction, and 400 times cheaper than processing a check. So if you believe that the universe likes a low energy state, and I do, then eventually adoption will happen because there is just a sheer cost advantage into that. When you look at most of the innovation in payment payments in the last 20 years or so, maybe longer than that, it has been mostly innovation on the front end, the user experience, or on fraud prevention. And PayPal has been one of the innovators there. But there has been not a ton of innovation in the fundamental infrastructure and the pipes that we use to move the money around. And this has been the first time that we have seen technology that has the opportunity to fundamentally change the way that we value around. And as a payments company, it is just too important to not have a cheaper payment.
So you guys are blockchain agnostic to an extent, interested obviously in bringing down the cost of payments. How does crypto do that? When we think about how we're sort of bringing down costs, is it interchange fees? What exactly does the blockchain bring to the table that makes payments less costly?
So when you look at, there are two ways to do it. You can look at it from the existing without geeking out on the payment ecosystem and four-party models and all of that and where the money goes. Again, fundamentally, you're paying a cost to the issuer, to the payment switch, to the network provider, to the acquirer. And that is money well spent. We have a payment system that works, and it has been working for quite a while. But when you think of the unit economics of it, it's still very much a fair value model. You pay a percentage of the value that is moving around. When you're talking about blockchains, you're talking about a per transaction. So if I'm able to run a transaction on the Stellar blockchain for pennies on the dollar, and it doesn't matter whether that transaction is 20 cents or $20 million, you start to be able to do things that you couldn't do on the traditional payment side. When you think of, and when we analyze blockchains for our own deployments, we tend to look at a few different things. Of course, we look at the technology, and security is a big part of what we look into. We look at the regulation, how familiar regulators are with a given protocol. We look at the community, how many developers, how many contributions to the repositories, what is the TVL on the ecosystem. And we look at payment. And some of those payment primitives that are the things that bring down the cost are still being developed. So when you're in payments, you need things like, you need a mechanism for the receiver being able to pay. A lot of blockchains, they work as a sender pays model. The person who's paying the fees or the institution is the one who's sending the value. Traditionally, on the payment side, the merchant pays, the receiver of the payment pays, and that's important. Things like confidential transfers are important. We will not get into mainstream payment use cases if merchants are going to have their revenue amounts and their monthly volumes posted publicly on blockchain. the programmability aspect is an important one as well. So it's not only the cost of moving value from one wallet to another wallet. One of the things that we say internally is that the payment is more than a transaction. If you're just moving value from one wallet to another wallet, that is helpful. But you need a layer of things on top of that, so you can do things like chargebacks, protecting merchant confidentiality and reputation and fraud prevention. So all of that is that drives cost, can be built on top of that fundamentally cheaper value exchange mechanism. But you need that fundamental primitive at the bottom of the stack.
When we spoke a few weeks ago, right, we brought up the idea of blockchains as cities. They're not all created equal. Some have certain benefits over others, whether it's security, composability, or whatever it may be. Everyone's launching a stablecoin now. You guys have one. There was reports that a number of other fintech firms, from Revolut to Robinhood, are looking to launch stablecoins. This guy's launching a stablecoin, apparently, I hear. I got my eyes on you. When we spoke, you said that it doesn't always make sense for a firm to have a stablecoin, and that not every firm will have a stablecoin. When you think about the profile of company where it does make sense, what is that profile?
So I don't think that stablecoins are natural. I don't think that there's going to be one stablecoin to do them all. There are obviously effects on these for the stablecoin, but I don't think that the state of the industry is going to be as heavily concentrated as it is today. Also, I don't think that we're going to have 55 stablecoins that matter. I think that you're going to have a few general purpose stablecoins that are broadly accepted for a number of use cases, and then you're going to have a bunch of specific ones. Maybe there's going to be one that is really good at redemptions of money market funds that is used by asset managers, and maybe there's one that is really good for purchasing goods in a gaming environment, and maybe there is one that is very good for machine-to-machine payments. So you will see a few general purpose ones. You will see a fragmentation of the longer tail of user-specific, and to the same theme of the prior panel before us, it is going to be important that you can move from one stablecoin to the other. This idea of the bridging of the layer zero. Today, quite frankly, layer zero is fiat, right? So if you want to go from different terminations of stable store of value, you will need to leave your stablecoin, go to fiat, and then go back up. Or you can go to bridging, but then engaging in counterparty risk for the types. So I think that this is one of those stations which is more the merrier. It is important, and we thought a lot about whether we can launch our own stablecoin or adopt one of the existing ones when we started the process about 10 years ago. The reason for us is that there was nothing in the ecosystem when we launched that we liked enough as something that was built for payments and for purpose industry. When we wanted to have something that was very strongly regulated, there was a ton of transparency on the assets, that was a blockchain neutral or blockchain agnostic. We didn't see anything we thought it was, well, this is going to be the stablecoin for the technology system. And that's why we decided to go with our maybe that's something that is going in the minds of those issues that are coming up now with new stablecoins. But I think that it benefits all parties, that there are more stablecoins there, that they are well regulated, and that they are interoperable. And I'm super excited to see some of those folks who are coming in play and to feel like this is generally good news for the sector.
Maybe we can take a moment to think about the evolution of the usage of stablecoins. If we turn back the clock maybe to 2018, 2019, right? This was really as a mechanism through which high-speed trading firms could move in and out of positions on crypto exchanges, to then being a form of collateral on exchanges, to then ultimately being the engine of decentralized finance. And now we're seeing a lot of peer-to-peer adoption and now merchant adoption. How do you see that evolution unfolding? And I wonder, right, will it penetrate more on the consumer side? Will it penetrate more on the merchant side? Or on the large scale enterprise side? Will we see firms like Ford paying their suppliers overseas via stablecoin? What will sort of be, how do you see that narrative unfolding?
I think that, as you were saying, Frank, the volumes today are still mostly around the trading and the markets, right? With centralized exchanges and DeFi. And that makes sense. The barrier of adoption for stablecoin on a consumer or a merchant mind is relatively high. You need to be quite adept at understanding the structure of wallets and what you can do there. For the layperson, not very expert on how blockchains work, it is a very intimidating experience. I remember I was in Singapore a few weeks ago, and I was super excited because I was able to top up my local wallet, the Singaporean wallet, to get the equivalent of an Uber. It's a wallet called Grab. I landed in Singapore. I was able to get my Grab wallet and top it up with my USD stablecoin from my North American PayPal account. That is wallet interoperability between North America and Southeast Asia, wallets that have nothing to do with each other. Wallet interoperability has been the holy grail of payments for a long, long time. You can do it now. Still, it required me to pull up my wallet on the PayPal side to make sure that I had a stablecoin to be able to transfer that on chain and to have that show up on the Grab side. There is nothing there that we cannot abstract that complexity from the eye of the consumer, but it has to happen. So the barrier of adoption on the consumer and the merchant side is we need to meet them where they are. To your point on Ford, we are starting to pay suppliers with our stablecoin. But to do that and to have that conversation with the CFO and the treasury team, you need to make it easy for them. So one of the things that we did to be able to do that is we work with SAP, the ERP provider, to make sure that our stablecoin was supported in their digital currency now. Because you're not going to get CFOs and treasurers to build a completely different flow to pay bills on a stable. They are going to be using the platforms they are familiar with. And if they don't know how to use your product, I think this is paraphrasing from Don Norman's very good design book. If your user doesn't know how to use your product, it's not their problem, it's your problem. So we need to make sure that it is really straightforward for them. And I do believe that you will see that adoption, that the adoption curve will move from capital markets cases where we are now to B2B cases. So I think that enterprises and merchants will adopt first, and then to B2C cases. And that will happen over time, and you will see more cases that are fiat on the front and a stablecoin on the back, where the user is not even aware that there is a exchange of stablecoins happening in the background, and they will just interact with their traditional fiat experience.
How do you think that's going to transpire, and where will it transpire? Having sort of stablecoin in the back without necessarily knowing that you're engaging with stablecoin.
Yeah, think about, for instance, the remittance space. Remittance is something that we talk a lot about in the stablecoin and the crypto space as one of the very good use cases, because it's peer-to-peer, it's expensive, it's cross-border. It has a lot of the peculiarities that are a really good fit for something like digital currencies to come and disrupt. It's something that is very close to the Stellar ecosystem. It's something that is very close to us. I have the privilege of also running Zoom, which is the digital remittance business of PayPal. And we move billions of dollars every year in people sending money to friends and family in their home countries. There are two things that are going on in that space. So we are seeing maybe three things. We are seeing people who are bypassing completely the traditional remittance establishment. We have now in our ecosystem, we have people who are sending our PayPal stablecoin from a Venmo wallet in the US to a Yellow Card wallet in Malawi, on-chain directly without going through any established remittance provider. And that's a very good use case that requires a certain level of familiarity with people. Then you have the next level, which is what we have enabled on the Zoom side. So now you can send money back. I can send money back to my family in Spain using Zoom. And if I fund it in stablecoin, as opposed to my debit card or my credit card or my bank account, you don't pay any transaction fees. We are able to pass on those cost savings to the user, and still the sender needs to be aware enough of stablecoins to have a stablecoin and send it, even if my family in Spain is receiving that in their bank account as they should. When we go to fiat up front, stablecoin in the back, I think that the future is for the remittance space is that we're going to see settlement with these government partners in stablecoin. If you look at it, remittance companies have literally billions of dollars that are parked in pre-funded accounts in the destination, because the reason that when I send money to the Philippines, the money arrives in 15 minutes is because the money was already there. And obviously there is a financial cost associated to that has to do with when you send money there, it's going to take 5 days for the SWIFT system to arrive there. It's going to have it has some implications for FX. It has some implications for counterparty risk. There is a fundamental advantage that you can discuss with any CFO and any treasurer, and they will get that by moving that settlement to stablecoin, you can save those 5 days float. You can have less money that is parked in the destination. You can get better FX because you can time your transfers to better FX flows. And you're going to reduce your counterparty risk because the money is going to be sitting there for less days in moments in which the banks are closed. And you can do all that, and still the experience for the consumer is going to be I'm sending USD into Filipino peso, and my relative in Manila is going to receive that as Filipino peso in their bank account. So I think that those are some of those use cases that you're going to start seeing that there. The technology is available, the technology is ready, and again, it's a very, very rational conversation to have with a CFO.
I'm sure you, given your seat, you've got a lot of people coming to the firm, right? Given PayPal's role in fintech and payments broadly. With myriad ideas, you see the good, the bad, and the ugly. Probably a lot more ugly than you'd like to. What do you think right now is the most overrated thing in the crypto digital asset market, aside from my podcast, obviously?
There is something that, staying on stablecoins, there is something that is very top of mind for me, and I think that for others in the industry, which is the monetization model of the stablecoins. I think that is something that the way that most people monetize stablecoins today is through assets through interest on the website, right? So you have stablecoins that are backed by financial assets, and then the issuers of those stablecoins are monetizing the service. I don't know that is overrated. It's definitely a very lucrative way to monetize, but I think that it creates, first of all, it's an artifact of the interest rate environment. I don't know that it's sustainable long term. Eventually, interest rates are going to be compressing, and some deals are going to be competed away. And I think that it does create fascination in the industry with the size of the market cap of stablecoin. That is probably not the most important parameter to watch. If you look at, I look at our stablecoin, and we are happy with the growth there. But if I look at the metrics that we track, market cap is relevant. And the market cap has increased 2.5x year to date. But active wallets is a metric that we care much more about because it's a proxy of how many people are using it, as opposed to just having the value in store. And that has increased 10x year to date. And lastly, we look at transactions. So the exchange of the stablecoin between wallets, and that has increased 30x year to date. If you ask me what is more important for us, is more people using the stablecoin more often. Whether that translates into a larger market cap or not, I think is less relevant. The industry is enamored with that narrative, and I think that's a little bit of a troubling narrative because it drives the public to think of this as a natural monopoly, which I don't think is true. We could move billions of dollars in remittance, going back to the remittance use case, we could move billions of dollars of remittances per year with hundreds of millions of stablecoin market cap. Is the velocity much more than the asset size that I think is relevant?
We're obsessed with market cap in this industry, for better or for worse. When you think about sort of capturing market share, though, a lot of people are wondering or thinking about the extent to which stablecoin providers have to share in the wealth, or share the wealth rather. So when interest rates were higher, right, the money that firms like Coinbase and Circle and Tether were making off of their stockpile of cash sitting at BNY Mellon or wherever it might be. A lot of people were wondering, is there a potential that some upstart could usurp them by kicking back some of that yield to the end user? But then you run into some other thorny regulatory questions, as you know.
And I agree with you. I think that those are the two aspects. One of them is the economics and the business decisions on what to do with those proceeds and how much you want or can share. And the other is the regulatory aspect. So whether you start to do that and whether that implies that it gets tricky into whether stablecoins can be considered commodities or e-money or securities or something else. I think that when you guys are sitting in London and also in continental Europe, there is the advantage that an instrument like electronic money is very well defined. People understand what e-money is, and that has a number of implications. While when you look at it from a North American perspective, the North American financial regulators don't have an instrument like e-money in there. The closest that you can get is store value, and store value is something that was more thought for prepaid cards and things like that. When you have something that is e-money, then it's very easy to get your stablecoin and put it in a bucket and say, okay, I can think about this as tokenized money. And then you can decide whether tokenized money can carry a yield or pay some type of rewards or not. When you're putting that on the store value bucket, that gets tricky because you really don't get rewards from the prepaid balance on a prepaid card that you bought at a store. So I think that both things need to happen. I think that the managerial question on what to do with the proceeds from those reserves is a business decision that different providers will think of in different ways, and depending also on which are the other ways that they have to monetize those flows. The regulatory question is one of those that I think should be clarified with regulation, especially in markets like the US.
Okay, now I'm going to ask you to pull out your crystal ball, look into the future a little bit. What are you anticipating over the next six months? What do you think is going to drive the narrative?
I think that the narrative, what you will see a deconcentration of stablecoins. You will see more stablecoins in the single-digit billions of market cap, which I think is going to be a healthy market structure. You'll see more clarity on the regulation of stablecoins. There is a myth that sometimes happens in the sense of saying, hey, the US does not have regulation for stablecoins. The US does have regulation for stablecoins. One of the reasons that we decided to issue out of New York or to adopt a stablecoin issued out of New York is that New York has a very clear framework for stablecoin issuance. But some of these ideas that you and I were discussing in terms of what to do with the deal from the reserves, etc., will benefit from more clarity. And I do think that the theme for the next 6 to 12 months, and for the developers in the room who are thinking about payment use cases for the stablecoin, I think that the themes are going to be, will continue to be cross-border. Most of the use cases that we're going to see short-term are going to be cross-border. There is going to be more B2B than B2C in my mind. And you're going to see more of those use cases that are fiat on front and stablecoin in the back. So the emergence of stablecoins as an infrastructure settlement layer, I think it's going to accelerate quite a bit as people like ourselves, the asset managers, the SAPs of the world, we make it easier for folks to interact with stablecoin.
Fair enough. Well, we'll have you back next year, hopefully in person, and we can see if all those things panned out. Thanks for taking the time.
Thank you, Frank.
We'll see you soon. Auf Wiedersehen.
Cheers. Bye-bye.
Thank you.